Hello and welcome to the Mutual Fund Show. I'm Niraj Shah. It's a show where we try and talk to mutual fund managers as well as advisors about how is it that we can give you the most optimum knowledge that you might require, or most optimum tools that we possibly can to help you make better choices on your mutual fund investments. Amongst the key topics that a lot of people have been thinking about is whether or not to invest into the BFSI space. Now, the way you can do it is through mutual funds as well and through BFSI funds. So, we're very happy to have Trupti Agrawal. She's founder manager at White Oak Capital, and she manages is going to manage the White Oak Capital BFSI fund, and she joins us right now on the show to talk about this space at large. Trupti, great having you. Thanks for taking the time out.
Thank you so much, Niraj, for having me.
So I'm just wondering, it's an opportune time to come out with a BFSI product because we know that the stocks, save for maybe PSU banks, haven't quite set the stage on fire. Maybe at some point of time, this relative underperformance might come to an end too.
Sure. So, Niraj, as a house, I mean, we don't really take sector views. We are a very bottoms-up stock selection firm. And hence, we just refrain from taking calls on sectors. And as you would know that, any NFO takes a lot of preparatory time. So in that sense, it wasn't really timed. But if I look at the kind of underperformance the sector has seen, which has been out of the ordinary. If you look at like last 20 years of data in the Indian context, financial services index has, in most years, barring the ones where there was a very significant crisis like a GFC or an economic shock like a 2011, in most of the years, the financial services index has outperformed the broader market. So it's only in the last 4 years that, we've seen an underperformance. And we think, while very difficult again to really, attribute what the reasons are, but we certainly think that given the dominance of large caps in this particular sector, the FII selling could have definitely played a role in the underperformance, which is what you've seen in, let's say, a bunch of IT names, in a lot of pharma names, many of the large cap. The large cap index has relatively underperformed the small and mid cap. Besides that, if you look at the construction of the index, nearly 40% of the weight, close to that, is in two companies, which have been extraordinary companies in terms of their execution and track record, but they are undergoing some kind of a transition. And I'm sure that, their underperformance has contributed to, or pulling down the weight. If you look at the broader, I think there are about more than 130 odd companies with a market cap of, let's say, more than 1,000 crores in just financial services. And if you look at the stock return performance of many of these companies, it has been quite good. So within, for example, the private banks, you've got a lot of regional banks which have done very well. The PSUs, I don't think I need to talk more, but most of the PSUs, be it banks, be it the power financiers, they've done extraordinarily well. You've got pockets like insurance, some insurance companies, again, that have done very well. So if you look at individual companies within the broader sector, they've done well. The index, unfortunately, has just 20 names, and it's hugely skewed towards two companies, perhaps, which have been going through this challenging time. So, my limited view would be that if you just look at, let's say, just the macroeconomic indicators, both, let's say, on an overall basis or specific to the sector, we think that the sector is in very good health, be it in terms of the ROEs. We are in, as one of the thought leaders of the industry has said, I just want to borrow his phrase. He says we are in Goldilocks times when it comes to asset quality. You've got very good, let's say, margin expansion. Asset quality is completely not spoken about. So the sector is in very good health. The credit growth has been holding up very well. Surprisingly, despite like such a sharp repo rate hike, the credit demand every fortnight is surprising. It's holding up, and maybe the regulator is trying to intervene and nudge to slow that down. So the sector is doing very well, and when any industry does well, and the stocks, let's say, if they don't move, then logically and mathematically the valuations, just start becoming attractive.
Sure.
So my, summary view would be that entering the sector at this time just gives a better margin of safety. From a valuation standpoint, we are nowhere in an overheated territory. So it just makes it sweeter. I don't know when this would turn and the mean reversion would happen.
Because you're saying it's not a factor of just growth, because growth has been there, but still the valuation decompression has pulled these stocks lower.
So valuation, I mean, as I said, growth has been very good. Profitability is intact. Many of the good companies have very smartly used this margin expansion to invest in, let's say, capabilities, in branch expansion, in technology investments. Many of them have created very good buffers, which would help them, let's say, when the asset quality cycle bites. So, in that situation, the sector is in its pink of its health. And if there has been, I think, pressure on the stock performance, the valuations are just getting better.
Got it.
So that, I think, would be my recommendation. I don't need to talk about the importance of financial services. I know, just like most other things, India is underpenetrated, be it credit, be it investments, insurance. We can talk about like category after category. Even within the broader financial services, we are an extremely underpenetrated country. So there's a huge runway for growth. The landscape is very interesting where, there was dominance because of the socialistic nature of our country.
Sure.
There was dominance of, let's say, SOEs or single players. And now we've seen that, many of them have donated a lot of market share over the years. And so there are players which have opportunity to grow, as I call it, at a GDP plus rate in this sector. Because the sector per se grows at a multiplier of GDP. And within that, you would have companies which execute very well and they can grow ahead of the industry. So, there is a possibility to grow at GDP plus growth. And you've got companies which have demonstrated that you can create business models which can compound at 18%, 20% year after year.
In the past, yes.
In the past, they've demonstrated that this is a sector where you can achieve scale. And despite being a cyclical sector, they've ended up being secular stories. They've compounded at 20%. So that's the attractiveness.
And you think that can continue?
Absolutely.
So therefore, just trying to understand, when you are or should people invest in BFSI funds, whether yours or elsewhere, with a view of, I mean, GDP plus can be +5, +15, +25 as well, right? I'm just trying to understand what is the average return that you believe can be par for the course, if you will, in a BFSI fund.
Sure. So, the way we internally think about it is that, we are talking about being in one of the fastest growing economies, where the expectation of the nominal GDP is to be around, let's say, 11-ish, 12% in the medium, at least the medium term. And typically, if you see credit or be it insurance or credit, they've typically been a multiplier, about like a 1.3 to 1.5 times the GDP. And then on top of that, if there are companies which are executing well and outdoing their peers, then they have a possibility to grow faster. So if you look at long-term data, let's say from 2003 to, let's say, until a few years back, you've actually seen companies in the lending space, in the insurance, which have compounded between 15 to 17%. And given the extent of underpenetration, I don't see any reason why that should not continue. And that's my base case assumption. And if I think about, let's say, multiples, like there's often a question that, is it right to look at historical multiples? Because we've got situations where, some of these companies have traded at very, very high multiples. So, of course, it's wrong to anchor yourself to past multiples. But even if, one does not take a call on multiples, you're still talking about an ROE compounding, which is a healthy 17, 18%, let's say, in case of very large banks. So a large cap name compounding at like 17, 18%, that should be the base case assumption. And if, there is a multiple re-rating, once, let's say, the external environment, let's say the liquidity situation gets better, there is more visibility on how the rate cycle is going to play out, deposits start easing, then, there is a very high possibility. And if an asset cycle breaks out, the players who stand tall, could have that re-rating. And so that could be your kicker.
You're making it very tempting, I must say. I'm inclined to ask you, how would the construct of your fund, for example, be different from what a BFSI fund could be? Because banks, NBFCs, maybe insurance companies out there, would you take capital marketplace, for example, or non-lending financials in a big way into the portfolio? Because a lot of people are talking about that.
Sure.
Just trying to understand if you give a higher than usual weightage to the non-lending businesses as well.
Sure. So Niraj, again, as a philosophy, we don't really approach portfolio from a top-down perspective.
Sure.
Ours is a very bottoms-up stock selection firm. I think one of the big advantages, or edge, as I call it, the White Oak edge, is the fact that, you know, we've got a very large BFSI team within the group. We are a 9-member strong BFSI team. And, you know, I'll be very surprised if any Indian manager is anywhere close. So we've got people within the team. So how we differentiate even on the team aspect is that we've got people who are from the industry. So I, for example, my own background is that I have been a credit analyst. I firstly come from a family of money lenders. I don't know how much of it helps in the portfolio management, but I would believe that there is that understanding that I carry. I have been a credit analyst before I joined White Oak. We've got members in the team who worked in rating agencies. So we've got people who've got first-hand domain knowledge of the industry they are working in. We don't have a very narrow analyst kind of a perspective on things. Number two, we've got members in the team who've looked at financials even outside India. As I speak to you, there are about 3 people in our team who are actively looking at emerging market countries. There are 24 countries that they are tracking very closely. And the idea for us is that, you know, there has to be a good cross-pollination of ideas. We need to understand, we need to cite business models or risks that have played out in other countries. And if there are some learnings, we would like to apply them to India. So that, I think, is a very differentiated advantage of White Oak. The sector per se has about 130 stocks, as I said. It's a very large coverage. It's a very data-rich sector where you get data on a monthly basis or even a fortnightly basis.
Sure.
And so having resources in-house just helps you focus on under-researched segments of the market. The portfolio construction is an outcome of what you find attractive at that point in time.
Okay, fine.
And I think if I just talk about the portfolio which has gone live, we are significantly overweight small cap. So the index is 92% large cap. We are about 30% overweight on the mid side. So we've already got, you know, and I think the index has about less than 1%, if I'm not mistaken, about 0.33% to be precise in small cap, where we are more than 20%.
Wow.
And we've got about 12 names from small cap holding, small cap, names that are already a part of the portfolio. So I think this kind of a capability to look at pockets in the market which are perhaps ignored, I think that is one area where we think we truly differentiate. And I think there is a certain perspective even on valuations where White Oak is differentiated in the way we look at things. And yeah, so those are the things. I'm sure that, you know, competition is good enough, but we also think that we'll do a good job.
No, I'm sure you will. Just a quick 30-second answer before we take that break. So
Sure.
You're not necessarily focusing on getting non-lending as a particular percentage. It will be strictly bottoms up as and when things come up.
Yes, you're right. That's how it is. And today, I think there are some non-lending segments in the market which don't even have representation in the index. We already have them in the portfolio.
Okay.
So
great. Well, Trupti, hopefully viewers get a sense of why BFSI funds might be a good bet. Trupti's laid it out beautifully for us and their portfolio construct in some fashion as well. It was lovely talking to you today. Thank you for taking the time out and being with us. But look forward to have you more often on the channel.
my pleasure, Niraj. Thank you. And I'm also looking forward to give you an update on, you know, how the fund is doing and what are the other differentiated things that White Oak as a group is trying to do.
Yeah, I'm sure it'll be great. But thanks for joining in today. Much appreciated. We now joined by Vishal Doshi, partner at Alpha Investment Services. Vishal, thank you for taking the time out and joining us on the show today. We were talking to Trupti Agrawal of White Oak, who's the manager of their BFSI fund. I was just wanting to understand from you, do you recommend for people who are open to taking thematic funds, do you recommend BFSI funds currently? And is White Oak the option that they have a good option, or would you recommend something else?
Yeah. Good afternoon, Niraj, and thank you for having me on your show. See, just to give you a little background, BFSI, as you would be well aware, is a main component of Nifty. Having said that, the weightage of the sector is perhaps at its lowest in the last 10 years. So to bet right now on a BFSI fund is like a contra call. So right now, although I'm not recommending BFSI funds to any of the investors, but for investors who are looking to have a play on the financial services sector, I think BFSI funds make for an interesting choice. So White Oak is a relatively new fund in this space, as you obviously know, and there are many other seasoned funds available in the industry, which investors can look at if they want to play the BFSI space.
Please be Vishal. I mean, so if you're not a White Oak fund, what funds can investors look at?
Neither investors can look at funds from fund houses like Sundaram, Invesco, Nippon. I think they have good funds in the BFSI space where the portfolio is fairly diversified between lending institutions, non-lending institutions, and facilitators, as we call them. Companies like exchanges, depositories, etc. So there is a good mix of portfolio available in this fund houses. So investors can look at funds from these fund houses.
Got it. Vishal, thanks. Thanks for that candor. Now, need to ask you a couple of queries if we have the time. We certainly have time for one. So I'm going to start off with the first query, Vishal. Sorry, apologies, but we have very little time on the show. Would have loved to talk more, Vishal, about other things, but I have to get in the queries going. So P.
Sure.
Anbajagan, his age is 61 years, and he asked that his call is that his monthly pension is 30,000 bucks and 30,000 rupees, and his approximate expenses monthly are about 25,000 rupees. So he would like to invest his retirement benefits of, well, 40 odd lakh rupees in mutual funds. And the person does not have any other investments at the moment. So his question is, can you suggest a suitable mutual fund scheme or a portfolio approach for doing this? Would you be able to help P. Anbajagan?
Sure, Niraj. I think you mentioned that he's got a corpus of around 40 lakh rupees.
Yes.
Right? Yeah. So I think he can have a mix of schemes from the large and mid cap segment and flexi cap. Given where we are in the markets right now, I feel these two categories would do justice for his portfolio. Naturally, a lot depends on his risk profile and the kind of risk he's willing to take in the market. But yes, a mix of large and mid cap as well as some multi-asset funds will also do well for him, given that debt is also looking attractive right now. So large mid cap, multi-asset funds and flexi cap funds.
Vishal, 30-second answer. Any names that you can leave him with?
Sure, you can go with HDFC Large and Mid Cap Fund, UTI Multi-Asset Fund, and the Parag Parikh Flexi Cap Fund.
Okay. Mr. Anbajagan, Vishal is saying that you can choose multi-assets for the diversity and the debt component as well. But otherwise, for the lump sum, the funds that he's mentioned, the categories that he's mentioned could be worth looking at. Afraid we'll have to take the other queries sometime next week. But Vishal, take a moment to thank you for being patient with us today. I know it's a truncated conversation, but thank you so much for joining us today. Looking forward to talk to you more often.
Absolutely, yes. Thanks for having me on the show.
Pleasure was ours, and viewers, thanks for tuning in.